Welcome to the Deep Dive. We're Talk Tickers, and we unpack earnings calls so you get the key insights fast.
That's right. No fluff, just what matters.
Today, we're diving into Havila TR's Q1 2025 earnings call. They're the company running that iconic Norwegian coastal route.
A really unique operation tied to that government concession. They just put out their first quarter results.
Exactly. So our mission here is to break down the numbers, what management said, the outlook, basically everything you need to know from that call.
Let's get into it.
Okay, first things first. The results snapshot. What was the headline number for Q1?
The big one was positive EBITDA, 11.2 million Norwegian krone.
Positive 11.2 million. Okay, and just quickly for listeners, EBITDA earnings before interest, taxes, depreciation, amortization is that core operating profit measure.
Right. A standard way to look at profitability before financing and accounting stuff.
So 11.2 million positive. How does that compare to, say, last year?
Well, that's the interesting part. Q1 last year, 2024, they were actually negative 18 million EBITDA.
Wow. Negative 18 million to positive 11 million. That's a huge swing.
Oh, a massive turnaround, yeah. And importantly, this is their fourth straight quarter with positive EBITDA contribution.
So it suggests, maybe a more sustainable trend, not just a blip.
Exactly. Seems like the underlying business improvement is holding.
Okay, and nearly 30 million krone improvement year over year. What did management say was driving that?
The main thing they pointed to was increased pricing, specifically higher average cabin revenue, or ACR. That was the big lift.
Pricing power. Makes sense.
Yeah, but they did mention it was offset a bit. They had a higher marketing spend in Q1, seemed a bit front-loaded. And also, those LNG fuel costs were pretty high during the quarter. You remember how spot prices spiked earlier this year?
Right, that volatility.
Yeah.
Okay, so strong revenue from pricing, but some cost headwinds. Let's dig a bit deeper then. What about the actual operations? How are the ships running?
Yeah, they really emphasized operational excellence. They reported 100% operational uptime for the fleet in Q1.
100%.
Yeah.
That's perfect.
Pretty much. And for that route, with the government contract needing reliability year-round, hitting 100% is crucial. It shows dependability.
Definitely reduces risks associated with that concession, I imagine.
Absolutely. Plus, they mention ongoing improvements across the board in operations.
Okay, and you mentioned average cabin revenue, the ACR. How much did that actually increase in Q1?
It was substantial, up about 35% compared to Q1 last year.
35%.
Yeah. Management was clear this pricing strength is like a key pillar for hitting their full year targets.
Makes sense. Did they expect that rate to continue all year?
They moderated that slightly. They expect the ACR increase for the full year 2025 to level off a bit, but still projecting a very strong 20 to 30% increase overall.
Still, 20-30% annual price growth is pretty impressive. How are they achieving that? Did they talk about their sales strategy?
They did. It seems like a conscious shift. They're focusing more on growing their direct sales through their website, their call centers.
Moving away from traditional travel agents then?
Not entirely abandoning them, it sounds like. They said they still value good agent partnerships, but the push is definitely towards direct channels.
Why the shift? Control.
Seems like it. More control over pricing, direct access to customer data, building that brand loyalty directly. It's smart, especially if you're targeting a specific kind of customer.
Right, direct relationship. What about the cost side of the equation? You mentioned fuel, but base costs.
They highlighted a stable, fixed cost base. That's important. It means their day-to-day running costs aren't ballooning.
So as revenue goes up from price and presumably occupancy.
Exactly. More of that should drop to the bottom line, boosting the margins, because those core fixed costs aren't scaling up at the same rate.
But Q1 did have some extraordinary costs, you said.
Correct. Those were mainly tied to those peak LNG spot prices, plus some upfront admin costs, things related to marketing, and also getting ready for refinancing activities.
The refinancing. We'll come back to that.
Yeah, but they expect those costs to normalize going forward. And as occupancy picks up in Q2 and Q3, which are seasonally stronger,
right, that helps absorb the fixed costs even better. Plus, they anticipate lower fuel costs based on current forward prices for LNG.
Okay, makes sense. Let's switch gears slightly. Who's actually traveling with them now? Any insights on the customer base? Is it changing?
Yeah, this was quite interesting. They noted a shift towards customers who really value sustainability.
Aligning with their own green initiatives, presumably.
Precisely. And also seeing more interest in shorter, more flexible trips rather than just the classic full-round voyage.
Shorter trips, sustainability focus. Sounds like maybe a different demographic than the traditional coastal voyage passenger.
Exactly what they implied. They explicitly said they're successfully attracting customers with a higher willingness to pay. And maybe the most concrete sign of that shift. The average customer age is dropping. It was down from 54 last year.
Okay, younger passengers willing to pay more for a sustainable, flexible experience. That sounds positive. It does. It suggests they might be tapping into a broader, maybe more premium market. And customer feedback backs this up. They mentioned a really high net promoter score, NPS, over 70.
And an NPS over 70 is generally seen as excellent, world-class even, measures loyalty.
Right. So high satisfaction among this evolving customer base. It all seems to point towards continued demand and pricing strength.
Okay, let's put on our investor hats now. What do they say about guidance? Outlook for 2025 and beyond.
This is where the call got quite focused. They narrowed their 2025 EBITDA guidance. The new target is greater than 400 million krone.
Greater than 400 million. Did anyone push back on that? Sometimes narrowing guidance can imply maybe hitting the lower end of a previous range.
Yeah, an analyst did ask about that. Management said it was partly based on the Q1 performance and the current booking situation. They seem comfortable specifically targeting 75% occupancy for the full year now.
75% occupancy target. How are bookings tracking against that?
That's the reassuring part. They stated that 81% of their full year capacity is already booked.
Oh, okay. So bookings are actually running ahead of that 75% target level.
Seems that way, yes. A strong position to be in mid-year.
What about the price and margin targets for the full year?
They stuck to their previous goals there. 20-30% price growth for 2025, consistent with the ACR outlook.
Right.
And aiming for a 20-30% EBITDA margin for the full year.
Okay. And looking even further ahead, maybe 2026.
They gave some initial signals. For 2026, they've already booked 21% of capacity.
Already booking for 26. Wow.
Yeah, and importantly, those bookings are coming in at prices roughly 15% higher than the already increased 2025 prices.
So continued price momentum into next year.
That's the indication. Their goal for 2026 is to push occupancy towards the 75-80% range.
And longer term, they have those ambitious targets still.
Yes, they reiterated the medium to long-term goal of 600-800 million in EBITDA, significantly higher than the 2025 guidance.
Quite a jump from 400 million to 600-800 million. What are the key initiatives to get there?
A big focus is building out those pre- and post-voyage services.
Ah, the add-ons like trains, hotels.
Exactly. Integrated train tickets, hotel packages, unique local experiences you can book alongside your voyage segment. It's about adding value, making it seamless.
And differentiating from the big cruise lines, I suppose.
Precisely. Big cruise ships don't typically offer that kind of integrated, flexible, locally focused experience. It plays into that shorter segment, higher value customer they're attracting.
And the foundation for all this is still that government contract, right? The concession.
Fundamental. It provides that baseline cash flow security. It runs until 2030, maybe 2031 if the government extends it.
And they want the next one too.
Oh, yeah. They made it clear they're gearing up for the next concession round, covering 2030 to 2040. That long-term state-backed revenue stream is a huge part of the investment case. De-risks things considerably.
Speaking of risk, that brings us to the financing. That bridge loan has been a major overhang for the SOC. What's the latest there?
This is super critical. They have this bridge financing facility. It's expensive, has lender-friendly terms, and it matures in 2026.
So they have to refinance it soon.
Absolutely. They confirmed they started the work in Q1. They've hired Arctic Securities as advisors to look at all the options. Public bonds, private debt, maybe even leasing arrangements.
Did they sound confident they could get it done this year?
They did sound quite optimistic, actually. They mentioned positive initial talks with potential lenders back in Q1.
What are the lenders like?
According to management, lenders appreciate the hard assets, the ships themselves, plus the security of that state contract, and crucially, the improved operational performance. That track record of positive EBITDA over the last 12 months seems to be helping a lot.
So the turnaround story is resonating with potential financiers.
It seems so. They're hopeful for a long-term solution this year. And interestingly, they're aiming for Euro financing.
Euro financing. Why?
They think it aligns better with their revenues and gives them access to, deeper, potentially more favorable capital markets compared to just staying domestic.
Okay, a key thing to watch this year then. One last item from the call. A share structure change.
Yes, a proposal for the AGM in June, a 50-to-1 reverse share split.
50-to-1. Why do that?
Pretty standard reasons usually. To boost the share price in nominal terms, make it look more substantial in both krone and euros. The idea is maybe it improves visibility, attracts more institutional interest potentially, needs shareholder approval, of course.
Right. Okay, that covers the main points from the call. Now, let's move to our favorite segment. Time for some outrageous but plausible trade ideas. And remember, everyone, this is absolutely not financial advice, purely illustrative fun.
Disclaimer firmly stated. Okay, let's brainstorm. Thinking caps on.
Idea 1. The refinancing catalyst play. You heard management sound optimistic about getting that long-term euro deal done this year, maybe Q3 even.
Okay.
The pitch. Go long Havila's TR equity, maybe even use options expiring late 2025, specifically betting on that refinancing announcement.
High stakes.
Exactly. The thesis is successful refinancing takes a huge risk off the table, validates the turnaround, lenders implicitly value the assets in contract, could trigger a major re-rating, maybe even a short squeeze if bears are betting against the refi.
It's definitely a catalyst-driven idea. The big risk, obviously, is if it gets delayed or the terms aren't great. Refinancings can be tricky. Those options could expire worthless.
Very true. High risk, potentially high reward. Okay, idea 2.
How about this? Seasonal strength meets pricing power.
Okay, tell me more.
We know Q2 and Q3 are their best quarters seasonally. And that's also when the full impact of that 20-30% price hike and potentially lower fuel costs should really hit the P&L.
Right, the peak earnings season coincides with peak pricing impact.
So the pitch, build a long position in the stock heading into Q2, Q3 results. Capture that potential earnings beat momentum.
Any hedge or arbitrage angle.
Maybe. If you could find a competitor struggling with pricing, you could short them against the long Havila's position. Or perhaps, if you were skeptical about fuel costs staying low, you could hedge with a tactical short on LNG futures for the summer months.
Interesting. Adds a layer. What are the risks there?
Well, peak season can bring unexpected operational issues, a ship issue, disrupting that 100% uptime, or a sudden drop in travel demand, maybe some external shock. And yeah, fuel prices could always surprise to the upside despite the current outlook.
Got it. So capitalizing on expected seasonal strength in pricing, but acknowledging operational and macro risks.
Precisely.
And again, folks, just brainstorming here. Purely hypothetical scenarios based on the call. Do your own research. This is not investment advice.
Cannot stress that enough. This is just us processing the call information. Always consult a professional.
Okay, so let's wrap up this deep dive on Havila's TR's Q1 call. Key takeaways for me. That big swing to positive EBITDA is real, driven by impressive price increases.
Absolutely. And that pricing power seems linked to a successful shift in sales strategy and attracting a higher value, younger customer base who like the sustainability angle and flexibility.
They've narrowed the 2025 EBITDA target to 400 million, but bookings are already strong against their occupancy goal.
And that crucial refinancing effort is underway, with management sounding optimistic based on early lender feedback. That's probably the biggest thing to watch near term.
Definitely. Future catalysts.
Yeah.
The refinancing news, whenever it lands.
Yeah.
And then the Q2 results later this year, which should really show the impact of peak season and peak pricing.
It'll be interesting to see how that plays out.
We hope this deep dive helped you cut through the noise and understand what management communicated.
Yeah, and maybe one final thought to leave you with. Consider how that combination, the state contract safety net, the improving operations now validated by lenders, seemingly how that might change the company's risk profile and strategic options going forward, especially regarding future growth and that next concession round.
Good point. Something to mull over. We'll be back soon with our next deep dive. Thanks for tuning in.